Major support for Carolina Business Review provided by Grant Thornton. Operating in more than 100 countries, our tax, audit, and advisory professionals specialize in helping companies unlock their growth potential. Colonial Life, providing benefits to employees to help them protect their family, their finances, and their futures. High Point University, the premier life skills university, focused on preparing students for the world as it is going to be. And Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries.
Someone once said that in everyday life, things go from pretty good to not so good. But seemingly, sentiment in the capital markets and investing have gone from flawless to hopeless. And our current situation is approaching straight-up panic. Welcome again to the most widely watched source of Carolina business, policy, and public affairs. I'm Chris William. Thank you for supporting this dialogue during this very special public health care crisis. On this program, we take a look at the surprisingly fast effect and advent of COVID-19 with someone who is near the center of regional and national money and fiscal policy that affect all of us. This is part one of a two-part conversation with the Richmond Federal Reserve President, Mr. Tom Barkin, and we will start in just a moment.
Gratefully acknowledging support by Martin Marietta, a leading provider of natural resource-based building materials, providing the foundation upon which our communities improve and grow. Blue Cross Blue Shield of South Carolina, an independent licensee of the Blue Cross and Blue Shield Association. Visit us at southcarolinablues.com. The Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. BARINGS, a leading global asset management firm dedicated to meeting the evolving investment and capital needs of its clients. Learn more at barings.com. On this edition of Carolina Business Review, part one of An Executive Profile, featuring Tom Barkin, President and CEO of the Federal Reserve Bank of Richmond.
Hello, welcome again to our program. Special thanks to you, President Barkin, for joining us.
Glad to be here.
And I want to say it this way because during this time when we have to keep our distance and we're exhaustively wiping everything with Clorox wipes or the like, you've kept this commitment to come and sit in the studio with us. So that's no small meaning, and I just want to thank you for that as well.
Glad to, and thank you. I've been assured everything I touched today has been clean. So
it has been hosed down, sir. Yes. I promise. This is part one of a two-part conversation with President Barkin. We're going to spend the next 30 minutes or so really taking a look at what the coronavirus impact is here and now, what the Fed has done, what the Fed might do in the near term, and then part two next week will be a little bit more expansive, and we'll unpack the idea of what post-corona at least immediate effect means and how it affects us in general, plus what is going on besides just COVID-19. So again, President Barkin, thank you. Let me start with this very visceral, violent, volatile reaction from the public markets, but the public in general. Has this reaction, does it correspond with the actual risk that it proposes?
I think about it as uncertainty. We took a world that was pretty known a month ago on a pretty steady path with markets in very good place, with the economy in very good place, and we sort of threw all that on its side. And so markets are reacting with uncertainty. You see the volatility day to day. I'd say employers are acting with uncertainty, and certainly as I talk to our employees and other workers, they're also very uncertain. What does this mean for them in terms of their health, which is one of those things that is just the core stable foundation. If you don't have your health, you don't have anything. What does it mean for your health? And then what does it mean for their business? And what does it mean for the national economy? So I'm not that surprised to see this amount of volatility because the uncertainty level is quite elevated.
Is it hard to tease out what's fact, what's actually historically provable? It's really a word. And what is just hyperbole?
It's very hard to figure out on the health side where exactly we're going. You can see ranges of infection rates. You can see ranges of mortality rates. You can see contagion estimates that draw a curve like this or one that draw a curve like that. So I think I'm certainly not an epidemiologist, and it's really hard to get grounded on where is all this going. Of course, our public health officials, they have to not just assume the best case, they have to assume what could happen. And so you see a bunch of initiatives in this state, in every state, that are trying their best to mitigate the potential downside of this. But I think to me, it's not an issue of hyperbole. It's an issue of true uncertainty about what the facts on the ground are going to show us.
So what's the role of the Fed then? How does the Fed lead?
Well, and I'm sure we'll talk about this more, there are three lanes in my mind. There's health policy, that's the role of our public health officials. There's fiscal policy, that's the role of our legislators, both state and national. And then there's monetary policy, which is what we do. And you want those three policies to be aligned and moving in the same direction, but you also want folks to stay in their lane. And so we've been focused on two things. First is rates. You saw about 2.5 weeks ago, we cut rates 50 basis points. Last Sunday, we cut rates another 100 basis points. That creates an environment of accommodation that stimulates as best we can consumer spending and business investment. At the same time, we are doing our best to help markets function. And if you look at the capital markets, particularly the bond markets, there's been a real lack of liquidity in those markets. People have been selling, other people have been buying, and those spreads haven't been at the normal level. And when they're not, then it's harder for consumers to have confidence in the loan rates that they would borrow against, think mortgages. It's harder for businesses to have confidence that they can access capital when they need it. And so we've been engaged in a bunch of operations, both buying treasury bonds and buying mortgage-backed bonds to try to calm those markets and settle those markets, but also creating facilities similar to such as one we did with money markets a couple days ago, to try to help make sure that people in those markets have confidence that their paper is going to have value. So,
and let me list a couple of things, and I know you know this, but for the benefit of our viewers, the idea that the Fed had two separate emergency cuts in federal funds rate, discount rates 25. Is the discount rate still 25 basis points, or is that
Yes.
zero? Is it? Yeah. Significant increases in repurchases, or what we call repos, new QE role guidelines and actual purchases, expanding dollar swap lines, changes in regulatory requirements. There's been over $100 billion of securities and treasuries announced purchase as of the taping date, which is Friday, March 20th. And so far, there has been $300 billion or so by securities purchased when in 08-09, the Fed did about $160 billion. So when we measure it by that one thing, President Barkin, does this mean that the Fed looks at this public health crisis in a more of an emergency light than the 08-09 financial issue?
Well, I certainly hope that what we've got is a relatively short duration health crisis that our health professionals will help us get through. And on the back end of that will be a recovery of the economy. I would compare that as different from where we saw in 08 and 09, which was the fundamental pillars of the financial system in 08 or in 09, the banks and other primary dealers, they were struggling. And without them being able to operate, the economy was unable to operate. This is different. Our health is a challenge. We're taking a set of behaviors that are going to have an impact on the economy. And you want to make sure the financial markets are calm enough that they can operate in that context. And so, I said at the beginning, there's a health lane, there's a fiscal lane. We're on that third lane, which is helping markets function to support it. And that's where we're focused. I do think this is a very different situation with different tools than we had back in 08 and 09.
So not worse, not better, just different. We're in more of an acute way.
We're in the middle of it. I think we'll leave to when we're done how to assess it. It was pretty ugly in 08 and 09, as you know. My strong hope is that we don't get to that level of ugliness, and part of that is each of our three lanes doing what we need to do.
I know people personally probably pull you aside and say, are you worried about it? Are you concerned about it? Because you don't seem like it. Of course, you've always been kind of of someone that is rational and clinical about the facts and history anyway. But I get the sense that you and the Fed are pretty cool-headed about this.
Well, first of all, I'm sorry if you don't think that I'm concerned about the impact of this.
I don't mean that.
No, and I'm talking, first of all, I have a family. What is the risk of me, us, one of our kids getting sick? Second of all, I'm in constant conversations around the district with employees who are worried about whether they're going to have a job. And I think really importantly, retailers, restaurant owners who are really sick to their stomach about what is happening here and the implication of our health strategy on their businesses. And I went to my dry cleaner yesterday whose business is down 80% and is wondering whether he has to go to shorten hours and lay off his one employee. I was with a shoe retailer who had to close all their stores yesterday, has 550 employees, and is trying to decide, can he keep them another week or two? Mm-hmm. And if he does, what are the implications on his ability to stay open and reopen afterwards, his cash flow? And so I think there's a lot of stuff to be concerned about, and I don't want to send any message other than that. In that context, I do think you take a job like the one I've taken because you want to be ready to act when it's time to act. And so I think Jay has done a great job leading us both in the first cut and then in this most recent cut, and then all week long as we're trying to do markets, which is keep cool, move, and don't debate whether we're having a crisis and how deep it's going to be. Mm-hmm. Go fast and go early, and you won't regret it mm-hmm. later if you went too far and too fast.
When you talk about employment in small businesses, obviously 80% of America's commerce machine is small business, if not more than that. And this public health crisis has eviscerated. I don't think that's over the top to say. Has eviscerated many people's payroll and expectations for revenue in the short term. How do you think this plays out when the Fed or you model out where we are 60, mm-hmm. 90, 120 days, et cetera, et cetera? What does the unemployment rate look like? Are we in a recession now, et cetera, et cetera? How do all these things play into when you're trying to look around a corner?
So I think first and foremost, health is everything. If you can't tell your family you're going to be safe at work or safe in a restaurant or safe in a hotel, then you can't get the economy moving in any way, shape, or form. We could get lucky. There could be a vaccine or a treatment, or maybe, heat lessens the virus, mm-hmm. some people will say. But I don't think you can count on luck. And so I come back to what is the timing for us to have a full public health protocol? And to me, there are two elements to that are critical. The first is testing. If you don't know if you're sick and you don't know if the people you're with are sick, I don't see any way for you to operate at any kind of scale. And so tests are starting to spool up. It's slower than I would have certainly thought 2 or 3 weeks ago. But if we can get testing at scale into this country, I think that's a critical starter. The second thing then is a protocol. And I go back to 9/11. I in my old job, I used to travel a ton, still do. And as I was home after 9/11, the question was, when is it safe to travel again? And you'll remember the country upgraded, spooled out, enhanced TSA quite significantly. Mm-hmm. It was a mess in the airports for 3 or 4 months, if you remember. But at the end of that, you felt like more was being done and enough was being done that you could feel safe to travel. And that's why I and a bunch of others decided to go back and travel. And it took a while to spool it up in full, but eventually we got back to where we were. We're going to have to think about that too, as employers, as store owners. What is the protocol that you could tell people it's safe to eat in this restaurant, it's safe to stay at this hotel, it's safe to go back to work? Mm-hmm. And importantly, because the coronavirus is a form of the flu, it's different from the one we're used to, I think the odds of getting it to zero are almost zero. I think there will be some amount of this on a constant basis. So the objective isn't to get to zero. The objective is to get to where this is a known, controllable, understandable thing where people can feel comfortable leaving their families mm-hmm. and going to a restaurant, a bar, a hotel, an airplane. And I think that if you don't have testing, you can't get there. And so your call as how long you think testing will go. I think that's more likely weeks than days until we have testing at scale. And then how long will it take for the protocol to be there that we can get comfortable? It's certainly somewhere after you reach the top of the curve. From a public health standpoint, that's what people say, but you won't know the top of the curve until you can measure it. And then once you get past the top of the curve, I presume there'll be some amount of time until we can all get comfortable going back to work again.
So it really comes down to deploying testing and having enough of the responses and or results of this testing to start to build some confidence that we're at least getting out in front of what it is.
And one thing that gives me confidence is China. I mean, China did shut down for 4 or 5 weeks. They are back operating. My sources tell me their economy is actually quite strong right now. Imports are booming, which is a sign. You always have after a downturn some bump. So they're having that bump. And I don't know whether to believe the numbers or not, but it does seem like the infection rate is down to very low levels. So there's a light at the end of the tunnel, but we need to get through that tunnel in a way that we can convince ourselves it's okay to do that again.
Do you get the sense that the 30% sell-off in the equity markets is probably finding a bottom? And I know you have to be careful about leading comments around what markets are doing and or that rates are stable, that there is liquidity coming back into fixed income. Do you get this in bonds? Do you get the sense that these capital markets, at least U.S. capital markets, are finding some semblance of calm?
I don't have any good sense of the market, other than to say that on a rational day, the equity markets ought to be valuing the future cash flows or distributions of the companies you invest in. It's pretty hard to know what those are when you don't know whether this virus is going to, take us down for a month or take us down for a quarter or take us down for longer. And so I think that level of uncertainty will lessen once you kind of can see the path out. I do think on the fixed income markets that we are making significant investments in it. And I do believe you are seeing some differences starting to happen. I think we've still got a ways to go, but I think we are starting to make a difference.
Is the Fed generally happy with the cause effect that you've been able to do with fiscal and monetary policy?
Well, what happens in these situations is you have a lot of tools on the shelf. Many of our tools were left from the last crisis. And so, you don't spend a lot of time overthinking, do I have exactly the, you sort of roll the tools out. And then some of those tools work very well from the beginning, and some of those tools work okay, and then you adjust them. And I think we're seeing a portfolio of those.
A lot of people ask, well, has the Fed deployed all that they have? I suspect probably not. But President Barkin, does the Fed in general feel like they have more, I don't want to say rabbits to pull out of their hat, but more tools to lean on and deploy and to use that haven't been used?
Well, we've taken rates down pretty aggressively, as you know. And this liquidity issue in the markets needs all of our firepower and more. And so as they evolve over the next several weeks, there are many more things we can and perhaps should do, depending on how the markets evolve. And so we'll see what that is. I think this is, I go back to where I started, which is this is a 3-lane challenge. We have lots more to do in our lane. You understand there's a lot of fiscal stimulus passed and even more being discussed. There's a lot more to do on the fiscal lane. And then importantly and critically, I think there was an editorial written a month ago that said the best stimulus is a testing system. If we can get tests and we get the protocol, I really do think once we're there, then you'll see the light at the end of the tunnel. I just think it's hard to see the light at the end of the tunnel when you're blind.
What happened 3 months ago? And years before that, there was a lot of chatter and a lot of fact that many corporations, many personal balance sheets had a lot of cash available. What happened to all that cash?
Well, let me start with the banking system, which is what we oversee. Had a lot of cash available, still has a lot of cash available. If anything, my understanding is that as people have been selling equities, they've been putting the money in cash. And so banks are actually more liquid today than they were a week or two or 3 ago. So that's one part of the system. The other part is personal. And I'd say that savings rates are up, but savings rates aren't up evenly. Fed does a study every year, and every year we find a really significant portion of this country wouldn't have cash wouldn't have the financing in place if they needed to find $400 in an emergency. And so you have to be wary of averages. On average, the savings rate is higher. On average, there's more cash, but that masks, people on both ends of the spectrum.
Yeah. So corporate debt levels. Is there a concern about corporate debt, the quality of it, the spreads between what they're being priced at and what they're actually worth, et cetera?
Well, I've said, and many of my colleagues have also said over the last 2 or 3 years, that corporate debt is elevated versus historic norms, and that creates a risk. It creates multiple types of risk. The one that you think about is, oh my gosh, you got the banks and they hold this corporate debt. Actually, 70% of that is off-bank balance sheets into loan funds. The risk I focus on more is, I'll call it the macroeconomic risk, which is if you're close to the edge and all of a sudden the economy gets tight, the more debt you have, the faster you've got to move, right? And that means move on layoffs or cutting investment or cutting hiring or cutting, other kinds of discretionary spending. And so the risk, I think, for sure you've got in some of these companies, risk of whatever bankruptcy and the like. But I think you've also got this macroeconomic, that more people are going to be laid off, that more investments are going to be cut. And that's a real risk. In terms of spreads, I think you also asked about, they are elevated right now. We've put a commercial paper facility in place just to make sure that the markets are functioning as well as they can in this segment. But I told you about the retailer I was talking to earlier. I think a lot of businesses, big and small, are in the world of saying, holy cow, I used to have this amount of cash coming in every month. Now I've got this amount of cash going out every month. How am I going to get from here to there? And there are some very painful conversations, and that's, I think, why Congress is talking about trying to support certain industries that have been hit by this.
How does that movie end in hospitality? A lot of local restaurants, as you talked about, the dry cleaners, travel, events, et cetera, et cetera. How does this end up?
Well, my hope is we're talking about a couple months here, not a couple years here. If we're talking about a couple months here, let's say I own a restaurant, and I've talked to some restaurateurs who are like this. Well, they try the takeout or the forget the fast foods, they try the takeout thing, but that's pretty hard to make the economics work on takeout. So, they have a sad day and they tell their employees, it's just going to be a month or two, we want you back, and they let them go. Most of these owners are individual business people. Their restaurant is their income. They have some savings, so they themselves can make it another, month or 2 or 3. They don't have a lot of debt because the banks don't actually like lending to restaurants. They do have a mortgage, right? Or they have rent payments. And so one of the first things they're going to do is go talk to their lessor. Right now, the folks on the other side of that are a mix of people. There are people who, 2 to 3 months is not a big deal, and they have people who are highly levered and feel like it's going to hit them in turn. But the thing for sure is they're not going to be able to release that space in a couple month basis. So there's nobody out there trying to find that space in this environment.
Does the Fed encourage the banks that hold that debt to be compassionate? Is probably not a technical term, but to be compassionate, forgiving on the loan to some degree?
We have, but again, there aren't a lot of banks in this debt. This is more.
But even on the mortgage side.
Oh, sure. And as I hear from banks, I do hear thousands of stories of individuals coming back for some sort of relief, and the bank's giving them that sort of relief. I think if you've got a healthy business and it's a couple month thing, there's light at the end of the tunnel. I think the challenge, this is where I come back to the public health side of this. The challenge is, what if it's not a couple months? What if it's all summer? What if it's longer? And then I think you really will have people making choices to exit.
Is there anything, we've got about a minute left, President Barkin, is there something encouraging, not that you haven't said encouraging words and trying to look around a corner, but what do you see out there that's a bright spot from the district?
Yeah, so 2 or 3 encouraging things. One, as I said, there are factories operating in China without illness, without sickness. So there is a way to get this done. Second thing that's encouraging is we have operations in a zillion different critical industries. Our cash processing operation in Charlotte and in Richmond, food processors, at plants around this country. Firemen and policemen. They're logistics people at Amazon or others. These are people who are showing up to work every day and aren't getting sick, right? So there are protocols, there are ways to do this where we can actually operate, as a country. And I think I certainly give full credit to the people who are making those operations work and the employees who are doing it. But I also think we can take some signal from that.
Yeah.
What are the things they're doing that are making this work, and how do we take that back into the service side of the economy? Because it's the service side that's really getting hit so far.
Save that for next week, and please come back. Thank you for being on.
No, thanks for having me.
Next week, it's part 2 of our conversation with Richmond Federal Reserve President Tom Barkin. We hope you'll come back. Good night.
Major funding for Carolina Business Review provided by High Point University, Martin Marietta, Colonial Life, the Duke Endowment, BARINGS, Grant Thornton, Sonoco, Blue Cross Blue Shield of South Carolina, and by viewers like you. Thank you. For more information, visit carolinabusinessreview.org.